Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, if you've been watching NDTV Profit through the day, you will know that Donald Trump, the President of the United States, levied an additional 25% tariff on India. The purpose or the reason behind that was because India is buying Russian crude. That's not something that makes Donald Trump very happy. Now, these tariffs don't come into play immediately. India has 21 days to talk to the US and figure things out. At least that is the interpretation. But then everyone's focused on what the implications could be for the Indian equity markets, for the Indian economy, for Indian companies, and ultimately for you, the Indian investor. So that is a question that we're asking on Your Money Matters today. Joining me is Vijay Mantri, investment expert and someone that you've seen quite often on this program. Vijay, thanks so much for taking the time. How much attention are you paying to this, and do you think that individual investors should worry about this?
So two factors. One is that I was reading the book of Neil Chaudhary, Indian Prime Minister. In that book, there's a reference of Mr. Vajpayee conducting nuclear tests in 98-99. And one of the questions was that will US put sanction against India? And at that time, Bill Clinton was leading the non-proliferation treaty, and he was the president of the United States. But India went ahead with nuclear tests and was sanctions imposed against India. But very interestingly, at that time, Mr. Yashwant Sinha was the finance minister, and Mr. Doval was the NSA. And they came and told PM that we are very comfortable because we have $30 billion of foreign exchange business. It was 98-99. We have a close to $16 billion forex reserve. So, and India is no longer India of 98-99. So that is the one part of the equation. The second part of the equation is, are we looking at selling our real estate? Are we looking at climbing down a business expansion plan? Are we looking at not continuing our investment in insurance or not doing bank FD? Why the entire focus comes on equity market and SIP, where allocation is only 5% of household savings. So there is a one question investors need to ask: why every time you come and look at the equity asset? That is the one part. Third part is that no big money ever made on the path of certainty. And in this market, we believe that it is a great market to start relooking, continuing your SIP, relooking more allocation over next 6 to 12 months, because all these uncertainty will disappear. But whenever these kind of situation or challenges come, they look very daunting at that time. Once the event get past, you always regret, past मैंने उस time पैसा डाल दिया होता.
The wisdom of retrospect is flawless. Vijay, to the second point that you make, let me play devil's advocate and argue that the volatility of equity market and prices of shares is significantly higher than the volatility in gold, in real estate, in fixed deposits don't change. And so therefore, the tendency, because you are experiencing a loss in that moment, of course it's notional, and if you book it at that moment, it becomes real, but the tendency is to feel anxious when you are witnessing that notional loss.
That's why very few people end up making money in the equity. You don't lose money in the gold, you don't lose money in the real estate because of price movement, because your holding period is forever. And patience capital come into these asset categories. Unfortunately, patience capital does not come into the equity. When people invest in equity, the expectation is that it is a multi-bagger. The expectation is that it will generate fabulous return. The expectation is that these returns will be linear. Like it will go like FD, it will go at 12 to 15%. And if you come with wrong expectation, and this is the challenge. So if you look at Indian equity market and particularly look at Indian equity mutual fund, which now have more than 30 years track record, fabulous wealth has been created. But I just take one fund's illustration because I track that fund and I work with that fund house, NDTV FlexiCap. Now that fund has grown investors' wealth 180 times in last 30 years. But that fund's average NAV fall 10% every 6 months, 20% almost every year, 20% almost every 4 years, and 50% almost every 8 years. If you are coming in equity market and look at the history, but when you look at the history, just don't look at last 1, 3, 5, 10-year return, but also important to look at how this return has arrived, what is the journey. And if this is the kind of money you need to make, then this is the journey you will take, your portfolio will take. There's no other way the wealth and equity will be created.
Okay. At this juncture, given what we know and the kind of uncertainty that's playing out globally, now there are some estimates that suggest, Vijay, that there will be some impact. There will be some impact to economic growth, not to the extent that some people might think, but maybe 30 basis points or 40 basis points. We are still the fastest growing economy in the world, and domestic facing companies, domestic facing businesses are insulated because the Indian economy, let's face it, is more domestic driven than anything else. So would you say that you adjust your investments accordingly just during this period of uncertainty? For example, a pharmaceutical fund that could be impacted by tariffs, if you have an oversized exposure, do you take that into account, or do you say, no, wait, I'm going to take a contrary bet, eventually things will turn around, and when the chips are down, IT for example, when the chips are down, you will invest in that moment so that you get the best price?
So, one of the best sector or thematic investing should be done when the immediate prospects are not looking good and the headline news is all negative. This is what we witnessed in year 2001, 2021 about PSU equity fund. And this is what we witnessed right now we're witnessing in IT consumption. In my opinion, if any investor who have patience, who have like 10 to 20% ability to withdraw some of the volatility, I think value is emerging in healthcare and tech thematic fund. But one need to consult their own asset allocation and decide. So that is the one part. The second part of the equation is that if GDP is going to take a knockoff of maybe 30 basis point or 40 basis point, also remember everything is interlinked. The money is made in the market on the basis of corporate earnings and corporate earnings dependent on GDP growth. And real estate does also get impacted to that extent. So when your business get impacted, corporate profitability get impacted, and also assume that your real estate portfolio may not deliver kind of return you expected. So everything is actually linked. So I don't think people expectation will be reset uh, based on the new data. So it just is a passing phase, in my opinion, and it is a great time to relook some of the sector which are completely ignored or being completely ignored. Continue with your SIP, and if you have a staying power, increase your allocation over the next 6 to 12 months in Indian equity market.
Since COVID-19, Vijay, people have gotten used to the concept of buy the dip. And we saw this early in the year. I saw a few memes on social media. Saw a few social media posts where people are saying buy the dip, but with what? Because they've already deployed everything. And so when the markets fell after that 10%, they could not deploy because they didn't have dry powder. So would you say that in these volatile times where things can flip on the flip of a coin, do you keep some dry powder ready, available for you to deploy in ideas that you like?
Yeah, the question is that is your money finite, which is like, don't you have monthly earning coming in? Don't you have anything else? So how does people buy real estate and continue to buy gold and continue to put money in deposit? So it's a false narrative being built around that. Where is the money to invest in debt? People have money, and if you look at average cash holding of Indian investor, there's enough money available on the table, and that's why we have this 100,000 coming in. I would look at investing and always, keep it very simple. Don't complicate things. Next 3 to 5 year of your household expenses, to keep in debt and debt-oriented products and don't take any risk on that. Beyond that, start putting money into equity. But whenever you put money into equity, be mindful that your portfolio may go down 10%, 20% any point of time. In this market, if you ask me, I don't see beyond double-digit kind of dip happening. And the market may test you for next 6 to 12 months, but that is the beauty of equity investing. Alex, in the beginning of 2025, I put my note that 2025 is going to be year of accumulation. This year will not generate significant return. And I continue to believe that accumulation phase. If you stay through the accumulation phase, then only you see the growth phase. Else you will not see the growth phase.
Yep, you said it. Vijay, thanks so much for joining in. Appreciate the perspective that you brought today. Keep it simple is the message coming through from Vijay Mantri once again. And 2025 is the year of accumulation. Use this opportunity to build up on your portfolio so that you can reap the dividends down the line.